And welcome back to Clear Talk, the financial series here on Sacramento Smooth Jazz, where we take a brief pause from the music to bring you clear and useful conversations about money, retirement, insurance, and of course, we've been talking about finance, and we call our in-house financial expert, Mr. John Nunes, serving nearly 30 years in the financial industry, and he's the CEO of Fortis Insurance Solutions. And we're so glad that he's here with us. If you have been listening for the last number of episodes, you should know that our core message for the most part is that if it's about your money, we should talk about it. That's what we believe. And we carve out about 8 to 10 minutes each time just to give you some insight. And we understand that, well, you should understand, I know you guys already know this, that retirement is not only about how much money someone has saved, it's also about which dollars are used first, which dollars are protected, which dollars to stay liquid, and how taxes, income, Medicare, and longevity are all coordinated over time. Now, this episode should bridge from the Roth conversion segments that you heard into a broader retirement income coordination. It's about the order of income, which can be just as important as the amount of income. And John's going to explain all that. John, first of all, welcome back to Clear Talk. So good to always have you here. How you doing?
I'm doing fantastic, Michael. You have a great listening audience, and that's why we continue these series. So it's my pleasure to be here.
Yeah, in fact, they're asking a lot of questions. I'm glad. And thank you for dealing with that as well. And over the last several Clear Talk segments, we spent time on Roth conversions, and listeners, of course, responded. Now, rather than simply add another part to that series, why is this the right moment to step back and talk about the order of retirement income?
Well, Michael, because what we did here is because the Roth conversion opened the door to a much bigger issue. The conversion, like we had talked earlier, it may help with taxes, but it's only one decision that's inside a person's retirement plan. So when we discuss that, the bigger question has to be, when your retirement starts, which dollar should be used first? Which dollar should be left alone? And which dollar should be positioned for dependable income? Because if that order is wrong, even if you have a good financial plan, that's going to create problems later down the road.
Now, when you say which dollar should be used first, what does that actually mean for someone who's had let's say, IRA savings, 401k, maybe even a brokerage account, Social Security, or even an annuity? What does that mean to them?
Well, what it means is the retiree needs an income sequence. Now, in other words, we can start off with what money pays the bills first. What money is going to stay liquid for emergencies? What money is going to continue to grow? What money is protected from direct market losses? What money may be used later for tax flexibility or legacy? Now, we all know that retirement accounts are not all the same, right? Because you can have $1 in the bank, you can have $1 in your traditional IRA, $1 in a Roth account, and you can even have $1 in an annuity. And each will have a different job because they're treated differently when it comes to taxes.
Yeah, looking at that as a whole, I can definitely see that. Now, a lot of people may assume that as long as they have enough saved, the account they use first does not really matter. Why can that assumption be dangerous once that paycheck from work stops?
Well, because the reality, Michael, is that retirement is no longer just about accumulation. It's all about distribution. Now, when we talk about accumulation, what most people focus on is growing that nest egg. And so when we talk about distribution, the order of them withdrawing money can actually affect their taxes, which is a big worry for a lot of these people. It can also affect potentially your Medicare-related costs, your required minimum distributions, potential investment risk, and how long your money is actually going to last. Now, if somebody is actually going to pull from the wrong account at the wrong time, what they could potentially do here is create a higher tax bill. They'll be draining their liquidity, and they can even force themselves to sell investments during a bad market.
And I'm sure a lot of folks have done that, selling investments during a bad market. Yeah, that's bad all the way around. Can you give listeners a simple way to picture the different types of retirement dollars before they start making withdrawals or income decisions?
Absolutely. Now, what I like to do is tell people to visualize about 3 buckets. Okay, so the first bucket we always look at is where there's taxable money, such as monies that is allocated to your checking accounts, your savings, your CDs, or even your brokerage accounts. Then you got that second bucket, and that's where your tax deferred money is, such as traditional IRAs, 401ks, 403bs, or any other type of similar account. And then finally, there's a third bucket. And this is where your tax-free or tax advantage money is, such as in a Roth account when certain rules are met. Then what we also do here is we then evaluate protected income tools, such as certain annuities might have. Because what's going to happen here is they may actually solve a different problem, which is creating dependable income. Now, the key here is that each bucket must be coordinated and not treated randomly. And then that's the important part of this.
I believe a lot of listeners know of someone that have done the random thing. And so we're not pointing fingers at anyone, but I believe that we all can understand that random order when we have retirement dollars in our accounts. We sometimes just feel, I'm just going to pull from certain accounts without a real plan. So John, where do Social Security or cash reserves and protected income fit into this order, especially for someone who is worried about, that market volatility or running out of money later in retirement?
Well, I always like to start by identifying the income floor. Now, what that means is that the amount of reliable income that's needed to cover your essential expenses, and we discussed this earlier, housing, food, utilities, insurance, your health care, or any other basic lifestyle needs. Now, Social Security may cover a part of that, and your pension may also cover a part of that. But there's some people out there where a portion of their assets are positioned in what we call an annuity. For some people, a portion of assets may be positioned in an annuity, which creates protected lifetime income, which is very important. Then cash reserves help avoid selling long-term assets at the wrong time, which is what a lot of people do. So once we define that floor, then the rest of the plan becomes a lot clearer.
And you often say that every dollar needs a job. How does that concept help someone decide which money should be used now, which money should be protected, and which money should be left for later?
Well, what it does here, it brings discipline to the decision. I know a lot of people make decisions based on fear, but this is where discipline comes in, okay? Now, some dollars are going to be allocated as income dollars. Some are going to be allocated as emergency dollars. Some are growth dollars, and some are tax-flexible dollars. Some may even be legacy dollars. Now, if we don't define what those jobs are, what's going to happen is retirees are going to make isolated decisions, like we said earlier, based on fear, what they see on the news or what they read in the newspaper, or even assuming that one account balance is going to take care of everything. But when every dollar is defined and has a specific job, that's when your decisions become more intentional. That is why we talked about a Roth conversion. That is when a Roth conversion, an annuity, a withdrawal strategy, or even Social Security timing can be evaluated properly. And that's what we help you do.
Okay, great. Now, for someone who's, let's say, 5 years away from retirement, or maybe even newly retired, or perhaps already taking income, what should they review first before pulling any money from the different accounts?
Well, what they should review first, Michael, is they need to review the monthly income that they need, the reliable income that they already have, the gap that could potentially remain between the two, how each of these accounts are taxed, whether their required minimum distributions may become a problem later on down the road. Medicare, how about their Medicare premiums? How could they be affected? How much needs to stay liquid? And what's going to happen to a surviving spouse? Very important there. They should also review market risk, okay? Because retirement income plan, it shouldn't depend on you having to sell assets at the wrong time just to create a paycheck.
Now, as I'm looking at this as the casual listener who's listening in right now, maybe for the first time, I'm thinking, just putting myself in their position, is this, what's the next step? What do I have to do right now? I may realize I have a bunch of different accounts and money's here, IRA, Roth over here, or, annuity over there, 401k over here. I don't know the order. How can I get the order? What do I do first? What's my next move?
Well, the one thing you don't want to do is you don't want to wait until you retire, because that's when everything becomes confusing. So what we need to do, and what we actually help our clients do, is we help them, Michael, build that income order before they have to make any type of major decisions. So that's what we do here at Fortis Insurance Solutions. We help you look at your taxes, your income, your liquidity, potential risk, longevity, all of that together. Now, if you go and visit our website at fortisinsurancesolutions.com/before you convert, we've actually put a free before you convert guide. It actually walks you through each step on what a Roth conversion is, and then how you're able to decide which dollar should be allocated in which bucket for them to determine in which order should they be able to use their income. And if they want something even more detailed, or one-on-one, we can actually schedule a retirement income strategy review, which is what a lot of your listeners have done. So our goal here today is to show people that you just don't retire with money. You need to retire with a plan, because somehow we need to figure out how that money is going to work.
Okay. Now, we have that guide on our website. They can access the guide, I should say, from our website. If you're already on sacsmoothjazz.fm listening to this, then I want you to scroll down. When you scroll down, you'll see John Nunes right there. You also see the guide. Click on that guide, even on the phone, and they'll take you right over to the site, and you can get your guide today and schedule an appointment with John. Now, John, if they want to just call you, some folks want to do that. How can they reach you?
Yeah, Michael, they can reach me at 1-800-900-3150. That's 1-800-900-3150.
Clear talk. That's what we're doing today. John, I really appreciate you bringing clarity to this subject, because a lot of folks have questions. A lot of folks didn't even know that they should put things in order as it relates to pulling monies out. So I really appreciate you just helping us out again today.
Yeah, I know we went through a lot of technical information, but it's information that everybody needs to know. And that's why it's my privilege to be here, to be able to educate your audience. And that's why I always say to come and reach out to us, because we'll walk you through it every step of the way.
Making it real simple for us. I really appreciate that. This is Michael Andrews. This has been another Clear Talk Financial Series segment right here on Sacramento Smooth Jazz. So let's get back to the music. Again, this is Sacramento Smooth Jazz, your escape from the noise.